from Chicago, Jim Bianco, the president of Bianco Research. Jim has been president of Bianco Research since 1990, where, among other things, he researches how the ratio of the equity market's capitalization as a percentage of nominal GDP.
Oh, my God. Do you really do that, Jim?
Break it down,
Yeah,
Jim.
you make it sound bad.
It's not. It was a
like a
mouthful I wasn't expecting. But why is it so important, Jim, to track that?
It's a valuation measure for the market, and it helps to strip out some of the noise you get from, say, looking at earnings per share, and helps you to determine whether or not the market is overvalued or undervalued.
And what does it tell you right now,
What
then?
are we looking at, then?
Right now, it's about the middle of the range. It was definitely overvalued in 2007, and it was way undervalued a year ago. But right now, we're kind of mid-range.
Hey, let me ask you what you're looking at as far as earnings. I assume you look at earnings expectations as well. We were talking with Ed Keon earlier, and he says 2011, he's getting first visibility about $100, and he says at 15 times you could expect S&P 1500. What do you think about that?
I think that's a bit aggressive for my taste, that we would get $100. I would think it would be more like in the $80 range or $75 range. And if you put 15 times on top of that one, you get about $12.50, and we're about 2 or 3% away from that number. So you could be, close enough for government work. You could say that the market's about fully valued at these ranges.
Jim, there is that debate that continues out there. It is different this time around. It's not different this time around. Do you agree with Jessica? I mean, in terms of what she's saying here?
Yeah, I agree with a lot of what she's been saying, that the recovery is a function of the previous decline, and the previous decline was unlike anything we saw since the 1930s. There's an old thing called the Zarnowitz rule from the economist Victor Zarnowitz, who did a lot of business cycle study, saying basically the harder you fall, the faster you rebound. And that rule isn't really working to the extent that you would expect. If we had a couple of quarters of minus 6% growth, we should see quarters 6, 7, 8% growth on the upside, and we're not getting anywhere near that. So this recovery is not like what we would have expected. And one quick thing about earnings. Yes, 80% of the companies are beating earnings. The last time we had less than 50% of the companies beat earnings was 1998. That just tells you that management has gotten very good at gaming the system and getting analysts to make sure that they're always a dime below estimates, as opposed to that is an indicator that things are doing better. Even in 08, when earnings were collapsing at a biblical proportion, 60% of the companies were still beating those collapsing earnings estimates. So I don't know what the 80% number really tells us, if anything at all.
Hey, we should probably talk a little bit about financial regulatory reform and the president, because it looks like the market's kind of turned around and rebounded after that speech. And as they sort of work everything through, they continue to move higher. Jim, why do you think that is?
Wall Street was fearing the worst with financial regulation this morning. When Senator Shelby came out and said something to the effect that he could work with the Democrats, that was it. 1,300 pages of financial regulation is coming. It's going to include regulations on derivatives. It's going to include a lot more onerous restrictions, and it was viewed negatively. I think now that they've had some chance to exercise, breathe into a brown paper bag, it's not quite going to be as bad as they thought. Now, that said, I would say that don't think it's not going to be good for Wall Street. It's definitely going to be restrictive for Wall Street, but not as draconian as we thought, say, at 9 o'clock this morning.
Does it seem, Jess?
What about the sovereign debt issues? Only because Greece back in the spotlight today. You've got Moody's lowering their credit rating another notch here. They're still 4 levels above junk, but nonetheless, that is still an issue that's out there big time. I mean, Jim, how concerned do we need to be with what's going on in Greece and some other countries, not to mention the growing deficit here in the United States?
We should be very concerned about Greece. I think that is also another thing that's been worrying markets as well, even through today. The gigantic rise in their interest rates has basically wiped out any kind of budget cuts that they have proposed and have enacted in the last several months, because their borrowing costs are going up. Greece is, if not now, is very close to being caught in a death spiral. Their rates go up. It increases the amount that they have to pay on interest, which then scares the market to send rates higher, which then further increases it. And that's not a good situation. Very few countries, when they get stuck in that, can actually get out of it without some kind kind of massive restructuring or default. And that's Greece is right on the precipice of it now. And don't look now, but Portugal's not that far behind them as well, too. The EU's got a big problem on their hands right now with what's happening in Greece.
When do we start to feel the effect? I'm not saying that we haven't, and we certainly see the markets, depending on the news, out of Greece and some other nations. I mean, it certainly does impact the market. But, I mean, do we see it to the point where it's a catalyst to really send global markets reeling, Jim, in your view?
It is in some respects. The dollar did make a new low against the euro today. You're starting to see the jitters in the European markets as well, too. But if the question is when are we going to start to see it affect, tech companies and healthcare companies in the United States? We're not quite there yet, because I still think things like 0% on the funds rate and the perspective of a recovering economy are still dominating our market. But this is background noise that is negative. It's background noise that is becoming a larger negative as we go forward from here. We could say it doesn't matter today, and that's true. But it's not going to not matter forever. It's just getting bigger and becoming a larger problem. And at some point, it's going to matter for our markets again.
Jessica.